When we see such a positive jobs report, 147,000 jobs and a lower unemployment level, what is this? What is driving this?
Good morning. Thanks for having me. Look, as you said a moment ago, this report was better than 78 out of the 79 forecasts that came into the Bloomberg consensus, right, into the Bloomberg forecast. And so what we see is an economy that continues to defy expectations, continues to defy, all the doom and gloom that's out there, whether it's about the border or immigration or tariffs. This labor market continues to power ahead. And something else that you guys mentioned, that Mr. McKee mentioned about the foreign-born labor force, I think there were tons of predictions that there'd be a disaster in the labor market because of the border policies, and nothing could be further from the truth. The economy continues to create jobs, and if you look at the details of the jobs, all of the job gains since the president took office are due to native-born Americans, and there's actually been a decline in foreign-born workers, which means that all of the benefits of the expanding economy are accruing to Americans instead of migrants.
Stephen, I do want to talk a little bit about what this means for the Federal Reserve. We know the position of the administration is that Jerome Powell and the Federal Reserve should lower rates here, but you take a look at the numbers we got this morning, that headline blowout print, the fact that the unemployment rate is now 4.1%. What would be the case to lower interest rates here?
Well, that's a great question. I want to be clear up front that the Council of Economic Advisors does not tell the Fed what to do on interest rates. But nevertheless, I talk about the economy. And, to me, it looks like an economy that's normalizing. This is a normalized pace of job creation, a normalized labor market. And the inflation rate has been running at a 1.5% rate since, the headline CPI has been running at a 1.5% rate since the president took office. So that's an economy that's normalized and is sort of maybe even running a little bit below where the Fed would normally think about inflation ideally settling. And so I think it's only a matter of time until interest rates normalize as well. Now, I want to be clear, I'm not telling the Fed what to do, but, I would just make that as a prediction.
Well, but we still have 3% inflation, right? Average hourly earnings were up 3.7%. And the president has asked the Fed not just to cut rates, but to cut them by 3 full basis points. In what world is that a good idea?
Well, it's an idea. It's a good idea in a world in which the economy is normalized, and policy will eventually catch up and normalize as well. And as I said a moment ago, inflation has been running at a very subdued pace since the president took office. It's been running at 1.5%. And I also want to emphasize that the president's suite of supply-side policies, through providing tax incentives for investing and building out the capital stock, deregulation, cutting red tape so that businesses can produce more with the same amount of resources, energy abundance, bringing gas prices down to the lowest price at the pump since 2021. These are all profoundly disinflationary. When you push out supply, you get lower price pressures. And so it makes complete sense to expect inflation to continue to normalize, to continue to run at a reasonable pace. Because if this is the opposite of what the previous administration did, where they stimulated demand into a rigid supply side. Instead, we're expanding the supply side, and that's going to reduce price pressures. But
I just want to follow up here, Stephen, because you got your PhD at Harvard under Marty Feldstein, which is a very good school. Can you imagine if the Fed cut 3 full percentage points? I mean, that either causes an overheating in the economy or chaos in the bond market.
Well, I think it depends. It depends where neutral rates are and how restrictive policy is. And as I said before, there's accumulating evidence that the economy is normalized. So, I think it's only a matter of time until interest rates follow. And as I also said, I think that, it's important to think of inflation as being not purely a monetary phenomenon. That's a bit of a fallacy. Fiscal policy plays an enormous role. And if government regulatory policy can push out supply, that brings downward pressure on prices. If you don't have enough goods and services and you make it easier to produce more goods and services, you get more goods and services and therefore lower price pressures. It's basic economics, supply and demand. And if you push out supply, there's less price pressure.
Stephen, I do want to get back to the details of this jobs report, but before we do, it seems like what you're arguing is basically that the Federal Reserve, and not that you're telling them what to do, but it seems like your argument is that they should normalize interest rates, get back to neutral, which does seem different than what we're hearing from the president himself, that they should not just ease policy, but ease it very aggressively.
Yeah, I mean, look, I think that there's a strong argument for the things that I just mentioned about policy normalization, and I think there's also a strong argument that the Fed has had a mixed track record in recent times of properly understanding the effects of fiscal policy. I mean, the president was right in 2021 when he said that fiscal policy was on a disastrous track and it was going to create massive inflation, and the Fed caught up to his view, which turned out to be correct, but it took them a while, and arguably they were too late. And I think again, the Fed is overly fixated on tariffs. There's zero evidence thus far that tariffs are leading to any macroeconomically significant inflation at all. You've got the Amazon, one of the Amazon CEOs coming recently and saying that inflation is not really showing up in their sales. You've got, evidence from high frequency prices in some of the research by my former grad school classmate Alberto Carvalho and others, showing that there's really only noise in terms of inflation of imported goods. And so there's just no evidence. And if you go back to 2018, 2019, same thing. We ran this experiment already. We have historical evidence. There was no material macroeconomically significant inflation, and yet the Fed is fixated on what's ultimately a small change in policy, a 10% tariff, whereas the other macroeconomic consequences of the other policies, deregulation, tax incentives for investment, these are going to be massively disinflationary, and I don't think that there's really a necessarily great understanding of the effects of fiscal policy on inflation, nor on growth. And this is why everyone gets the growth forecast wrong over and over and over again about the effects of taxes on growth and revenue.
I'm glad you brought us there, and you did your dissertation on that, households reacting to federal tax policy. In terms of tariffs, we've been talking about this. We're all positively surprised. Companies have had huge margins, and they're able to absorb, it looks like, some of that into them so far. In terms of growth, when we cut $4.5 trillion in taxes over 10 years, but then only reduce spending by $1.2 trillion, isn't that a red flag? I mean, historically, you look at the Reagan tax cuts, we saw exploding debt and deficit from that. You look at the Bush tax cuts, we saw an extra $6 trillion in deficits after those. You look at the 2017 TCJA, we have seen another $1.8 trillion added to the deficit. I mean, can you point to a time in the U.S. history when when cutting taxes but not meeting those cuts with requisite spending cuts has resulted in the kind of growth that you're forecasting, 4 to 5% of a dynamic growth boost?
So that growth boost is over a 4-year period, and so if you divide it by 4, it's about a percent over that. It's about a percent over that period. But I think that we've got plenty of good evidence, right? So first of all, our forecasts are that we'll get in the neighborhood of 2.8%, close to 3% growth over the next 10 years as a result of the full suite of the president's policies. But that's exactly what the growth rate was in the first term until COVID. The GDP growth in the president's first term from 2017 to 2019 was 2.8% annualized over that period. And I don't think anyone thinks that we can blame COVID on the Tax Cuts and Jobs Act. But it gets better when you look through the pandemic disruptions. There was no discernible decline in revenues as a result of the Tax Cuts and Jobs Act. Revenues as a share of GDP was 17.1% before the Tax Cuts and Jobs Act, and it was 17.1% last year. Corporate revenues went from 1.6% to 1.9%. So the corporate rate was cut enormously. There were huge incentives for investment. There were, reductions in statutory and effective rates, and yet corporate revenue increased as a share of the economy. And this is exactly the type of activity that you want to see when you think that tax cuts, when you think that deregulation, when you think that energy abundance, when you think that all of these things are going to boost economic growth, and that brings in more revenue.